Welcome back to Markets Today. We are joined by David Gittau, who's an analyst at Citon. David published a note with an overview and an update on Kenya's public debt and the situation. Welcome to the show, David.
Thank you.
All right, so give us the synopsis of your report. What is your report about and what are the key findings?
So the last report that we did on debt, we are trying to look at the evolution of debt in the recent years. And so far what we had seen and our consensus was so far, like this year, we have a debt total of around 6.7 trillion.
Okay.
Of which, if we were to look at the evolution, just since COVID started in March, we are at around 6.2 trillion. So in that just a few months, we have accumulated around 400 and something billion in terms of debt.
All right.
So the other thing we were looking at was the evolution in terms of if it's in terms of growth, both the foreign as well as the domestic
Yes.
debt, as well as also in the foreign debt, what is the composition in terms of both multilateral and bilateral, as well as in terms of the commercial debt.
Okay, so what are the debt levels? Are they getting a bit worrying to you when you look at some of the ratios? If you compare the debt to GDP ratio, is that a bit of a concern?
Right now it's a concern because from the last numbers that we saw, debt to GDP stood at around 62% of GDP, and that is looking at as at the end of the last financial year, without even factoring in the element of COVID-19. Factoring in the element of COVID-19, we expect GDP probably best estimates to grow by around 1.5% thereof, of which debt, from what I've talked about, from March to around July, at the end of July, we have already accumulated around 400 billion. So it can show you how the levels of the percentage of growth in terms of debt, as well as the other side denominator, that is the GDP, which is around 1.5.
Yes. Okay, interesting. So it's suddenly rising, and of course there's the impact of COVID-19 on this particular number. Is it going to get worse? Do we see a situation where we move from perhaps 61% to 80%?
Okay, for sure we expect probably a higher number by the end of the year, because from what I've just mentioned on the GDP side, we don't expect a higher GDP, a higher number, more than probably 1.5% best case scenario. If you look at the other side, for example, things such as the revenue side, this year we had an estimation, the government from the budget, they estimated the revenue side to grow to around 1.8 trillion. From the outer numbers that we got just the other, just a few weeks ago, for the last financial year, the revenue numbers for full year 2018-2019 came in at around 1.7 trillion.
Okay.
And that is without factoring in COVID-19. This year the revenue estimates around 1.8 trillion. So for sure we won't hit those numbers.
Okay. All right. So what's the opportunity, before we get into the crux of your report? Is there an opportunity for then investing in fixed income? What's the outlook been like when you look at the interest rate environment?
Okay, in terms of fixed income, so far, even from the numbers that we are seeing, from the T-bill subscription, from the T-bond subscription, etc., there was an opportunity, yes, probably for earlier investors, because we've seen so far from the position the yield curve was till now, it has readjusted downwards. So for investors who are probably holding, who are investing in the fixed income for trading purposes, they have already gained by around 0.1% or thereof.
Okay.
But for now, due to the increased demand, because we've been seeing investors maybe since COVID started, we have seen the flight from probably equities to the fixed income market. It has pushed the yields relatively downwards.
Yes. All right, that's interesting. So because of COVID and the uncertainty, that we had started seeing a lot of demand going to the fixed income space.
Yes.
And then there was, because of too much supply chasing one single opportunity, the rates sort of came down.
Yes, as well as the high liquidity that we currently have.
Okay. So then do you see an opportunity for a switch? Do you see money moving from fixed income space to possibly equities or even real estate at this point?
Okay, probably by the end of the financial year, we expect probably a slight upward readjustment of the yield curve, because like I mentioned, if you look at the revenue side, we are from the budget that was read, we were looking at a fiscal deficit of around 800 billion thereof. But due to probably a decline in terms of the revenues, because we don't, like I said, we don't expect those 1.8 trillion numbers. For sure the government might have a lot of pressure in terms of plugging in the fiscal deficit. So with that, we might see probably an uptick by the end of the financial year.
Okay, all right. And then your report starts off with some of the credit rating agencies. What has been the outlook for the rating for Kenya at a sovereign level?
So for the ratings that we've seen so far, they reaffirmed the credit score. The only issue that was there was we saw a downgrade in terms of the outlook from stable to negative for most of them due to the increased, the heightened risk of default.
Okay. And when you're looking at Kenya, do you look at other debt issuances by other countries, or at least the ratings for other countries, and how does Kenya compare?
Okay, the rating wasn't, the decline in terms of the outlook, it wasn't a Kenyan issue only.
Yes.
It was a global thing because COVID-19 definitely is a global pandemic. It isn't affecting only Kenya.
Okay. So which means you should pay attention to the rating, but then it's neither here or there because it's things that are exogenous to the country per se.
Yes.
Okay. Then you also talk about Moody's, and then you talk about the Fitch rating. Have this changed considerably, or are they more or less at the same level?
It's more or less at the same level.
Okay, fine. Then should we be concerned? That's what your report talks about. Should we be concerned about the debt level?
Okay, for the debt level, for sure we should be concerned so far. Because for the ratios that we were talking about, for example, the debt-to-GDP ratio so far, it's above the recommended thresholds of around 50%. Right now, we are at around 62%.
Yes.
If we were to look at maybe things such as the debt service, the debt service revenue,
Yes.
there's a debt service to revenue ratio.
Okay.
By the end of the year, it was at around 45%. But if you look at what we currently have this year, we are servicing around 904 billion in terms of debt repayments.
That's a lot of money.
That's a lot, of which on the revenue.
It's almost $1 trillion, which is, if you think about it, that's almost half of what we expect to collect in revenue.
For sure, because
Wow.
the expectations, even if, for example, best case scenario, we have the revenue that we collected last year at around 1.7.
Which won't happen really. Maybe 1.5 is...
It won't happen for sure.
So then you're saying 3/4 of your revenue is going to go to debt.
So best case scenario, for sure, if we were to collect the 1.7, it would be around 52% thereof.
Yes.
So for sure there we have a problem.
Okay.
And in terms of probably the rising cost of debt, from the evolution of debt that we've been seeing, like around 2013 there of around 90% of the foreign debt was from multilateral and bilateral lenders. And for you to maybe understand the impact of that, like right now, the debt that we've been receiving from multilateral lenders during this period of COVID-19, we've seen like around 750 million the other day from IDA. It was we were supposed to service it at for around 30 years, and it has a grace period of 5 years and a rate of around 1.35%.
Okay.
Although now commercial debt has risen from less than 10% to around 30% now. And if you were to look, for example, like at a Eurobond, a 7-year Eurobond is currently issued at around 7% thereof. So you can see the cost of debt.
Exactly.
It's going higher.
So when you talk about the multilateral, which is really the extent of the foreign debt vis-a-vis the local debt, what's the split like today, and what's the thinking? Where are we headed in terms of the views on that split?
So in terms of foreign and domestic,
yes.
For this year, from the budget that was read, it's the mix, it's around 42%, of which 58 is local debt, and then 42% is foreign debt.
Okay. Is that expected to continue that way? In other words, do we expect the government to keep raising additional domestic debt, at least in the short to the medium term?
Okay, in the short to the medium term, for sure, because with the credit ratings that we have right now, it means that if we were to go to the foreign markets to to try and raise debt, we will be getting the debt at higher rates than we are having right now.
Okay.
And we already have that problem of having expensive debt so far.
Okay, yes, because I also see from your chart that you're saying there's been a gradual uptick when it comes to commercial debt in terms of it making up the majority of the foreign debt. So commercial doesn't come with concessions in terms of lower debt or grace periods. So what does this mean then? I mean, if I want to invest in the fixed income space and you're telling me that debt to GDP is a concern and it's going to get worse, you're telling me that the government will keep borrowing locally, you're telling me that the cost of debt is a problem, and we're in the space where the yield curve has been coming off. Do I expect this trend to continue? In other words, will I get less in terms of returns if I invest in debt in Kenya today?
So in terms of debt in Kenya today, what we are recommending from even our reports and for local investors is that it depends with the motive for the investor. For instance, you'll see that firms such as pensions funds, for instance, they usually invest for the long term. So if, for example, a pension fund has been given a coupon of around 12.5%, it doesn't present any risk so far because they are given that rate of return from the onset. But for other investors with the motive of maybe investing for trading purposes, we are currently advising people to invest mainly in the short-term paper so as to avoid that duration risk.
Okay, so short-term paper, is that the 364, is that the 182, is that the 91-day paper?
From our end so far, let's say 1 year to around 5 years thereof, because if you were to look at the T-bill so far, like the 91 days trading at 6.2%.
Which really doesn't make
sense. And I think that's why if you have looked at the trend these past few weeks, all the papers are being undersubscribed because of those rates.
All right, fantastic. Okay, then your report then delves into what we were discussing earlier in terms of the debt service to revenue ratio. Now this is becoming a concern because you're saying if we raise 1.7, almost $1 trillion shillings has to go to debt servicing. COVID has happened. It's highly unlikely that the government will raise 1.7 trillion in terms of revenue, possibly 1.5, give or take. So if you have a government that raises 1.5 trillion in revenue from taxes and uses 1 trillion of that to pay for debt and is only left with 500 billion, and it has to deploy money to the counties, it has to deploy money to the parastatals, it has to deploy money to infrastructure. What does this mean?
For sure, that's where the main concern is so far, because like I mentioned, we're expecting, when the budget was being read, we're expecting around 904 billion in terms of debt repayments and servicing the interest payments and all that. With the COVID, maybe we can even see a higher number because we haven't factored in things such as the currency depreciation.
Exactly. Actually, that's a good point.
Around 6.8%. So when it comes to the interest payments, they will definitely go upwards.
Okay.
And the other thing you mentioned, we already have ongoing budgets, e.g. the counties, etc., and services have to continue and all. So what we foresee probably in the short term or in the near term, for example, that budget deficit we're expecting of around 800 billion, which will be supposed to be plugged in by debt. We probably expect to see the government even borrowing more so that they can pay debt. That is just borrowing from Peter to pay Paul at the end of the day.
Wow.
Because we don't foresee any other alternative right now.
Okay, I mean that's an interesting situation. So then let me throw a spanner in the works. Do you follow the U.S. Economy, because they have a similar scenario where their debt to GDP ratio is nearing 100%, and their long-term papers are at less than 1 percentage point in terms of return. Do you foresee a scenario in Kenya where our interest rates then take that trajectory, where the yield curve just keeps going lower and lower and lower because the government has to keep on taking debt, and there are issues affiliated with not inflation necessarily, but this currency risk? That's a key risk area. Do you see a situation where maybe the 10-year could trade at 8% in 2 or 3 years?
In our economy right now, I don't think it's a possibility at all.
Okay, all right. So we'll just remain where we are, more or less.
For sure.
Okay, all right. Then now your report continues just to look at the key matrices. I think we've covered most of them: the government to GDP, the total debt to service revenue, the total public debt mix, domestic versus external, that we've already covered. I think maybe the other thing that we need to be able to look at from your report, that's the current account balance. What is happening on this particular line, and how is debt impacting this?
So for the current account balance, in our country right now, if we were to look at maybe in terms of foreign exchange, the top foreign exchange earner so far right now, it's from diaspora remittances.
Okay.
And in as much as probably it has been stabilizing so far, like on a year to date from the last number that they gave, I think the diaspora remittances on a year-on-year comparison had grown by around 23%. So from the diaspora remittances side, let's say, at least it has been stabilizing. But if you were to look at the other foreign exchange earners, things such as tourism receipts, etc., they definitely have been on a decline due to the travel restrictions that have been implemented in most of these countries. So on the current account side, for sure there is a major problem right now, because the Kenyan shilling has already depreciated by around 6 point something percent, around 6.8, 6.9% there.
Yes.
So if the currency has depreciated by around the 6.8%, it basically means that even servicing the foreign debt will be more expensive as compared to maybe what we had earlier projected. And from the other foreign exchange earners, from that other side, we are already facing a challenge in earning foreign exchange. So we expect probably the current account to continue deteriorating.
Okay, we take a short break. When we come back, we will finalize on the conversation of the current account deficit and the possible impact this could have on currency, especially for those of you who normally trade currencies and have been looking at the Kenyan currency as a base. We take a break and we will be back shortly.